Hi everyone and welcome to my channel. This is a new video about CHPY. Can this 40% yield last? Basically, this ETF is putting up a distribution rate over 40% and it's built entirely around semiconductor stocks. So that combination alone gets attention. But here's the question I actually want to answer today. Can that kind of income hold up over time, or it's borrowed from somewhere else in the portfolio? We're talking about CHPY, the YieldMax Semiconductor Portfolio Option Income ETF. It's had a genuinely strong run since launch, and its NAV has actually grown, not just its distribution. But semiconductors just went through a sharp crash and a fast rebound, so this is a great moment to stress test the whole thesis. Let's dig into what's really going on. First, what's exactly CHPY? Its full name is the YieldMax Semiconductor Portfolio Option Income ETF. It was launched back in April 2025. It's actively managed, so it's not passive. It is a portfolio manager managing the position actively, and it holds somewhere between 15 to 30 US listed semiconductor companies directly. Right now, it's sitting around $1 billion in assets. It has an expense ratio close to 1%. Now, here's something a lot of people get wrong going on. CHPY is not a semiconductor dividend ETF. Most of the companies it holds barely pay any dividend at all. Almost all of the income, the distributions you will be getting or you're seeing, comes from options, not from the underlying stocks themselves. That distinction matters a lot. Matters a lot for everything we're about to cover. So how CHPY generates income? Let's break down how this actually works, because it's not as complicated as it sounds. First, CHPY owns real shares of semiconductor companies. That's a direct equity piece. If the stock goes up, the fund benefits at least 2 points. Second, the fund sells call spreads against those holdings and collects a premium for doing that. That premium is where most of the weekly income comes from. Now, here's where things get interesting. Semiconductor stocks are naturally volatile, and volatility makes options more expensive. So the fund gets to collect bigger premium than it would selling options on a calmer sector. And this is an important trade-off. The more upside it sells away, the less it participates when the stock really takes off. In other words, when you're selling covered calls, you are capping the potential gain, because when you sell a covered call, the first thing you do is you set the strike. This is the maximum gain for you in terms of capital gains. And because you set a limit to how much you can make, people are willing to pay you an option premium. So this is why inherently covered calls limit the upside. But as we will see later, CHPY managed actually to do well even with the strategy being built in. And the difference between an option income fund like CHPY and a direct exposure, let's say buying directly a fund that just holds semiconductors with no covered call, we will see that the difference is not major. So the fund did really well. So what's happening? The 2026 rally. Let's look at what actually happened in the first half of 2026, because it explains a lot about CHPY numbers. Semiconductor stocks went to an incredible run fueled by AI infrastructure spending. Some of these stocks more than doubled off their 2025 lows. For a fund like CHPY, that's about as good as it gets. Rising share prices, high volatility at the same time, which means fat premiums on top of real capital growth. That combination is a big reason CHPY NAV, the net asset value, climbed over 130% cumulatively since inception. Let me repeat that. The NAV, the net asset value, since the creation of the fund climbed over 130%, and working out to roughly 80% performance annualized total return. Impressive numbers, no question. But numbers like that almost always come from a specific environment, not from the strategy alone. And in this case, it was a very favorable environment in the first half of 2026. Then July hit and things flipped fast. Semiconductor stocks dropped roughly 20% in a matter of weeks, the worst monthly stretch the sector had seen since early 2000s. A more hawkish Fed, stretch valuation, and a leverage AI-focused hedge fund blowing up, all piled on at once, if you follow the recent news about that hedge fund. And here's where many investors get confused. They assumed the option income should have protected them from that drop. It didn't, not fully. CHPY's NAV fell right along with the sector. The premium cushioned some of the pain, but they didn't erase it. Then, just as quickly, Semiconductor rebounded hard in early August, which is good news if you're holding the fund. So, what does mean that for you? The fund moves with its sector, it doesn't move independently of it. And this is an important idea that you should keep in mind. When you're holding an option income fund, you're not holding options, you're holding equity, you're holding stocks. The portfolio that the manager manages matters a lot, much more than that distribution yield you're looking at. This is why when you invest in an option income fund, you have to be at ease with what the portfolio is holding. You have to be bullish on semiconductors if you're holding this fund. You have to understand what type of companies are in there. Are they quality companies? Are speculative? You have to always look at the portfolio, because that's what will bring you wealth after, not those distribution yield. Is the quality. If the portfolio is rising, the options are there, then that's great. If the portfolio is declining because it's speculative, because it's not quality stocks, then you shouldn't be in that fund in the first place. So this is a very important something that you need to remember when you invest in an option income fund. Always look at the portfolio. Now let's talk about those weekly payments, because this is where a lot of the excitement and a lot of the confusion comes from. CHPY pays out every single week, and the dollar amount moves depending on option premium and how volatile the underlying stocks have been. As we mentioned, volatility equals option premium. The higher the volatility, the higher the option premiums. Right now, the distribution rate sits above 40%, but that number is simply the most recent payment annualized. It's not a forecast, it's definitely not a guarantee. If volatility drops and the rally cools off, those premiums shrink, and so does the payout. I want to be really clear here. A 40% distribution rate does not mean a 40% total return. Those are two completely different things. So let's talk about the return of capital, the elephant in the room. Should you worry? Let's talk about the return of capital, because this term tends to scare people more than it should. In plain terms, ROC means part of your distribution is classified as your own money coming back to you, rather than income or gains. And here's the thing, that's not automatically bad. A fund can distribute some ROC while its overall value is still growing just fine. As of the most recent distribution, CHPY reported 0% return of capital, meaning the whole payment was classified as income. That's a healthy sign right now. The real warning sign to watch for is a pattern, a distribution consistently outpacing what the fund earns, and combined with a NAV that keeps drifting lower over time. This is your two major signs that the fund is in trouble. Other than that, the fund is doing really well so far. So now let's compare CHPY with a pure semiconductor ETF. At first glance, you might wonder why not just buy a plain semiconductor index fund instead. Fair question. Over the past year, SOXX returned north of 110%, while CHPY came in closer at 91%. That gap isn't a mistake or underperformance, it's direct cost of selling those call spreads. CHPY trades away some of that explosive upside in exchange for a much bigger, more consistent income stream. So CHPY has a different clientele than SOXX, because basically it's more geared towards income investors. And frankly, 91%, this is great. It's not that far from the pure semiconductor ETF. And the ride is also smoother because you're selling covered call. You're selling those call spreads, which smooth the rides, and you're getting income on a weekly basis versus holding a pure semiconductor ETF where you're not getting any distributions and you're just head on facing the volatility. So this really comes down to what you're trying to accomplish. If you want maximum growth potential from semiconductors, a plain index fund captures more of the rally. If you want meaningful income along the way, CHPY is designed for that trade-off instead. So here's something worth pointing out. A lot of high yield option income ETFs have a reputation for slowly eating away their own NAV, even while paying big distributions. CHPY hasn't followed that pattern so far, and the reason isn't really a secret. It launched right before one of the strongest semiconductor rallies in years. Rising prices combined with high implied volatility created the best possible environment for this kind of strategy, real growth and rich premium at the same time. But I would encourage you to think of that as a favorable set market condition, not a proof that the fund has cracked some special formula. That combination isn't guaranteed to repeat going forward. Always, a fund shouldn't be 100% of your portfolio. It's a great fund, but it has to be like, you have to stay diversified. Do not think that the past performance will repeat itself. The biggest risk, this is where many investors get confused. Let's slow down here. Option premiums provide some downside cushioning, but only some. If semiconductor stocks entered a real extended bear market, CHPY would still lose value right along with them. The income collected from options would only offset part of that decline, not all of it. Your weekly payments would keep showing up, but that doesn't mean your account balance is protected. I want to say this plainly. A 40% distribution rate is not a 40% downside protection. It isn't downside protection at all, really. If you're drawn into CHPY purely because of the yield, make sure you understand the risk before you go any further. A high yield does not mean downside protection at all. So let's balance things out and talk about what CHPY actually does well. First, the income itself is substantial and it arrives weekly rather than monthly or quarterly. Second, you get direct exposure to the semiconductor and AI growth story without picking a single winning stock yourself. Third, there is diversification built in it, since the fund spreads exposure across 15 to 30 companies instead of concentrating on just one or two names. And fourth, this one will surprise people because CHPY uses call spread rather than pure covered call approach. There is still some room left for capital appreciation with this strategy. That's part of why the net asset value has actually grown alongside the distributions rather than only the distributions growing. Now, the other side of that coin, CHPY is concentrated entirely in one sector. So if semiconductors underperform for a while, there's nothing else in the fund to offset that. The volatility that generates those rich premium also means sharp price swings in both directions, as we just saw in July. The option strategy caps some of your upside. So during strongest rallies, CHPY will typically lag a plain semiconductor fund. And honestly, this fund still has a short track record. It's only been around since April 2025. Through one big rally and one sharp correction, that's not a full market cycle yet, so it's worth remembering that. So who should consider CHPY? So does it actually make sense? The fund tends to fit income-focused investors who are also genuinely bullish on semiconductor long-term and who are comfortable with real volatility along the way. It also fits people who already understand how covered call and option income fund behave in practice. On the other hand, if you need a stable, predictable income, or you can't stomach a sudden 20% drawdown, this probably isn't the right tool. And if the only things pulling you towards CHPY is that big yield number, pause for a second. That's exactly the kind of decision that tends to go wrong for investors, chasing the headline number instead of understanding the mechanism behind it. So back to our central question, can CHPY keep producing this kind of income while preserving long-term value? Right now, the answer looks reasonably encouraging. The net asset value has grown, return of capital is low, and the fund behaved about the way you would expect through both the rally and the correction. But I wouldn't extrapolate that indefinitely. Going forward, keep an eye on the few things: the net asset value trend over time, total return rather than just distribution, and the ROC percentage on each payout, and how the broader semiconductor sector is doing. If distributions start consistently outpacing what the fund actually earns, that's what your signal story that the story has actually shifted and changed. So here's what I want you to take away from all of this. That 40% number is eye-catching, but it's not the number that determines whether CHPY is actually working for you. The NAV preservation, the net asset value preservation is. Total return is CHPY had a strong run so far, largely thanks to an extraordinary period for semiconductors, and that the same sector strength is also its biggest risk going forward. As always, this isn't a financial advice, just an honest breakdown so you can make your own decision. If this helped you clarify how CHPY actually works, hit like, subscribe for more breakdown like this. I will put also the link to the full article in my blog, wiseinvestors.com, if you want more details. Thank you so much for following up.